Welcome back. We will go into the second lecture in the fourth module, valuation of equity share, which is about dividend discount model. So, in the first lecture we just talked about why equity valuation is required and what are the different methods which is available. Here we will talk about the dividend discount model. What do you mean by dividend discount model? What is the need for having the dividend discount model, and what are the different types of dividend discount models what we have. All these things would be discussed in this particular lecture. So, what is dividend discount model is the first question. So, it's nothing but a valuation method for what? So, you are trying to find out the value of the stock or the value of the share of your company based on theoretical aspect. So, why I say value of stock based on theory? Because this is not the actual value. The actual value would be different. Actual value would be different, whereas theoretically, based on whatever studies have been conducted, formula has been derived. Based on those formula, we are trying to find out what should be the value of the stock, but it need not be the actual value which is reflected in the market. Okay. And the second reason why you have to do it is because you want to find out the value, present value of future dividend payments. So, if suppose I am purchasing a share of a company, let us say TVS, at 200 rupees today, and they have a normal dividend policy of say 18%. Okay. So, it means to say that at the end of year 1, and let us assume that I am going to hold it for 5 years. At the end of year 1, what is the amount of dividend you would be getting? You would be getting 36 rupees, right? Similarly, second year you would be getting 36, like that for 5 years you would be getting. But I am trying to find out the value of this 36 rupees which you would be getting at the end of 1 year, what is its value today, right? The value of 36 rupees which you would be getting after 2 years, what is its value today? So, in order to do this, I am going to discount it at a particular rate. Okay. So, we will go into those details as we proceed. And this particular model, it is grounded in the concept that value of investment is determined based on the cash flow generated for the investor. So, it means to say that whatever investment I am going to make today, it is dependent on the cash flow which I would be generating in years to come. So, the actual value of this particular asset, that is this share of 200 rupees, would be different from the actual value, face value which is written over there. So, I have to incorporate all these present value concepts so that I can find out what is the actual value the investor is going to get normally in case of dividends or dividend paying stocks. Okay. And what is the purpose of dividend discount model? It normally helps the investors to get the equity fairly priced. Okay. You can find out the value of equity based upon the income it is going to generate in future, as on date what should be the amount you can pay for it. So, it is a model where I am trying to find out the actual payout for a particular share, at what price I have to purchase a particular share, if suppose there are certain conditions like its normal functioning is showing a return of say x rupees after every year, right, or it could be a management decision also. And discounting is necessary because I want I know about future dividends, but I do not know its present value. Why should I do this? I am required to find out the present value because theoretically this should be in tune with the intrinsic value of the share. So, what do you mean by intrinsic value? Intrinsic value is nothing but the value of assets which the company hold. Right, after deducting the liabilities, after considering the liabilities. So, I am trying to find out the total value of assets less external liabilities, which is going to give me the capital employed, right, divided by the number of shares are outstanding, is going to give me the value of 1 share. Okay. So, I am trying to find out whether this value which I am going to get is reflecting these aspects or not, because I am saying that I will be giving paying a dividend of 10%, 20% or whatever it is in future. So, I am converting it to current day's rate, and then I am trying to find out the value of that particular share. What is the principle of dividend discount model? It assumes that the stock's value is derived from expected future dividends. So, any shareholder is going to get return in the form of dividend. So, the value is derived from the future dividend which you get, and I am going to convert it into current rate by discounting it, and it assumes that the dividend are direct reflection of company's profitability and growth potential. So, if the company is declaring a dividend of 18%, it means to say that this 18% is coming from the profit which the company would have generated, right. So, indirectly or directly, this has a reflection of your company's profitability and the growth potential. Otherwise, it does not become sensible to use this particular method. So, what do you mean by discounting future dividends? Discounting future dividends is nothing but I am trying to find out the present value of future cash inflow. Okay. How do I calculate present value of future cash inflow? It is nothing but 1 upon 1 plus r to the power n. N is the year. So, if suppose I want to calculate the value of say 30 rupees, which I would be generating 30 into 1 after 1 year at a normal rate of return which is there in the market as 10% at the end of 1 year, plus again I am earning 30 rupees at the end of second year, which is 1 plus 0.10 to the power 2 plus 30 at the end of third year, like that for nth year to the power n. So, this factor is called the present value factor. Okay. So, this is the future cash inflow. This is the I am converting this future cash inflow into the present value. So, this is how I am trying to find out the future dividends are discounted to their present value. And why do I do it? Because time value of money is an important factor. So, what do you mean by time value of money? Time value of money says that 1 rupee in your hand today is more valuable than 100 rupees in your hand after 1 year. So it's as simple as that. So if suppose I have 1 rupee today, I can enjoy the benefits of 1 rupee rather than keeping this getting 100 rupees after 1 year, which may not be even enough for me to buy food for one time. So that is the reason why we say we have to find out the time value of money. So in order to calculate this, you are requiring this particular rate of return, which is called R. So this rate of return is required. This is considered to be the discounting rate at which. So this is normally market driven. Either I can I can find out what is the normal return rate which is available in the market, that could be considered, or the minimum acceptable rate which as an individual I expect, I can consider that also. So based on this, the future dividends are being discounted, and this is how the calculation is being done. What are the different types of dividend discount model? The assumption of dividend discount model is that we are trying to say that there is a dividend growth rate, okay, and with this as the basic assumption, you have two basic models. One is a zero growth model. In zero growth model, it says that the dividend is going to remain constant indefinitely. So it means to say that if suppose I say I am going to give you a dividend of 18% every year, irrespective of the profit whatever I am going to generate, this is considered to be a zero growth model, where whatever be the profit, I am going to give you only 18 rupees for every 100 rupees. So that's what you mean by a zero growth model. Then you have a constant growth model. Constant growth model, it has another name, it's Gordon growth model. Here what is happening is, I say that every year there will be a growth rate of say 1%. So this is constant, this is going to be the growth rate every year. So first year I am going to give you 18%, second year 19%, third year 20%, like that it is going to vary. So this is considered to be a constant growth model, where you assume the dividends to grow at a constant rate over time. The third type is called a multi-stage model. Multi-stage model, it assumes that at different stages of the life of a company, the rates are going to differ. Okay. So the dividends will grow at different rates during different stages of company's life cycle. So I told you, for the first year I am going to give you 18%, then I say there will be a growth rate of 1% for the next 5 years, and after 5 years this will increase to 5% for the next 5 years, etc. So I can go on like this. So along with the growth of the company, the dividend whatever you are going to get is also changing, right? So that is called a multi-stage growth model, where you have different rates of growth which is available over there, right? Now let us go into the details of these. So zero growth model, how do I calculate the price of what is the price at which I have to purchase a particular share is depicted as P naught. Okay. This is found out by finding out how much dividend I am getting at the end of the year divided by the expected rate of return. So this is how I find out the value of the share. Okay. So now let us assume that the dividend is 18%, so 0.18, and expected rate of return is 10%, so 0.10. So what is the price of the share which you can purchase? It becomes 18 rupees. So if suppose you are going to get the particular share at 18 rupees, you can purchase it. If it is beyond 18 rupees, it is not worth purchasing this particular share. And if it is less than 18 rupees, it can be purchased. So that's the meaning of this particular model. So it assumes that the dividends remain same for indefinite period of time, and it is very simple to calculate. And when it is used when companies with stable and consistent dividend are being given in companies which are regulated, or sometimes where cash flows are predictable or growth factor is minimal. So these are in terms of utilities and other things where I can talk about say FMCG products, right? And so such utilitarian items I can identify. I can talk about a zero growth model. A constant growth model, as it is shown over here, the price of the share is determined based upon the dividend whatever I have got into the growth factor, that is 1 plus G over R minus G. So why I have done this is, if suppose I am going to expand this, it becomes like this. It is dividend divided by 1 plus R to the power n plus the growth factor, right? So G1, G2, it goes on. So if it is first year, let us assume this is G, growth factor is same, this is 1, plus dividend plus growth divided by 1 plus R to the power 2 plus dividend plus growth divided by 1 plus R to the power 3, etc., divided by 1 plus R to the power n for nth period. So if suppose I am going to solve this particular equation, it comes to be like this. It is the dividend, present dividend, into 1 plus growth rate divided by R minus G. Okay. So here in constant growth model, as we told in the earlier case, it is the rate is going to increase constantly over a longer period of time. Okay. And this is normally useful for mature companies or stable growth companies. When it is used, as I have already discussed, matured or stable companies or situations where growth is predictable. So normally you find that blue chip companies follow a constant growth model. So whenever in years where they make excess profit, they keep certain provisions which will be used in years when the company is not making that much profit. So I say I am going, how much ever profit I am going to make, I am going to give you an additional dividend of 10% every year. So in case I have made, in 1 year I have made a huge profit, so I am going to transfer some amount into dividend equalization fund. Equalization fund. So what is this fund used for? This fund is used for meeting out this paying of 10% of dividend in situations where the company is not able to generate the minimum required amount of profit. Okay. So that is what you mean by that. And the assumptions over here is dividends will grow at a constant rate and the growth rate G is less than the required rate of return, that is R. So which means your expected rate is more and growth rate is less. So that should be the condition. So this can be done mathematically. Now let us go to the multi-stage growth model. So in multi-stage growth model, in the introduction I have told you that you will have different growth rates for different periods. Okay. and this would be reflecting the company's life cycle. So, if suppose you are in the growth phase, you may be going in for a multi-stage growth model, okay. And the life cycle of a company or an industry I have already discussed when we were talking about fundamental analysis. So, depending on the life cycle of the firm, it is going to determine whether it is going to give a stable growth rate or a lower growth rate, whatever it is. So, from here the growth rate can increase, over here it can become stable, here it can again decrease. So, that is how we are trying to find out, okay. And what are we doing with multi-stage growth model? As we did in the previous case where you have calculated the current value of future cash inflow, it is the same thing which is happening over here also, where I am trying to find out that 30 rupees this year at 1 plus expected growth rate of 0.10 first year, okay. Let us assume the second year also I am going to get a growth rate of 10%. Third year the dividend is increasing from 30 rupees to 40 rupees. So, it goes 0.103 plus like this it goes on. So, I can calculate what is the present value of the future cash inflows based on the different rate which it is which I am getting as dividend, okay. So, I am going to use the present value of dividends separately and then adding them up together. So, I am finding out this separately and then adding it together, because there is a growth rate involved, as I had shown in the previous example. D plus G is there. So, here as you proceed you will have G1, this would be G0, right. So, up to this particular stage you will be calculating separately. When it goes to G1 till it becomes G2, you will be calculating separately. After that I am going to add it together and find out what is the value of this particular share, which is represented as P0, okay. And normally you will find that whenever, since we are talking about life cycle, always a high growth period is followed by a constant growth period, and then it will normally come down. So, this is this formulae is actually put up by Gordon, and it is known as Gordon growth model. And what are the conditions under which we are going to use Gordon growth model? It is useful for companies which is expected to have a rapid growth initially and then becomes stable over a period of time. So, what are the companies which follow this type of phenomenon? It is either the technology market or certain type of goods which are new in the market, which is expected to grow at a faster rate in the initial part of their life. Such products can also be part of companies which talks about growth in dividends. What are the strengths and weaknesses of dividend growth model? As we saw in the previous lecture, you will find simplicity is one of the thing, because it is very straightforward, and zero growth model, for constant growth, it is very simple to calculate. You have only one set of calculation, and zero growth, there is no problem, you do not have the growth factor over there. The second is you can focus on actual cash flows. So, actual cash flows could be found out, because I know the dividend whatever I am going to get, and what is the actual cash return to the shareholders is understood beforehand. So, that is the strength. So, beforehand I can determine how the money could be used, because I know this is the amount of dividend I would be getting. And third, it is relevant for dividend paying companies, because this is going to help the company in taking a decision for having a stable dividend policy or any other policy in dividend decision. Okay. So, if suppose the growth rate is considered to be in a constant rate, then I can say that the company is following a stable dividend policy based upon their performance. They are foreseeing their performance to be like that. What are the limitations? It is not suitable for non-dividend paying companies because you do not have any future cash inflow, so there is no point in finding out the current value. Then there is sensitivity to assumptions. So, assumptions like whether it is in the growth phase of the company or whether there is a sluggishness in the market. All these things, if suppose I am assuming, and if it happens, fine. If it is not happening, then this may not be the case where I am able to pay the dividend as expected. And it is limited to accounting for capital gain. So, what does it mean to say? I am not talking about capital appreciation, I am just focusing on the dividend return alone, because in all the formula you will be seeing dividend upon the expected growth rate, and if it is multiple stage, I am going to use the present value factor plus the growth factor. So, if suppose there is a growth factor in this, I am going to put this like this, or if it is constant dividend, it would be like this, right. So, plus the growth factor, if it is there, I can use the growth factor over there. So, whenever I am trying to do this, what is happening is I am not able to capture the capital appreciation. I am solely talking about the dividend growth or dividend return which the company is giving. So, in this particular lecture, I have tried to discuss about the second type of equity valuation, which is the dividend discount model. Though I have not touched upon the problems which is there, I think this will give you an outline into how the equity is valuated under different conditions. The first one was using balance sheet valuation method. The second one is the dividend discount model, and problems at a later stage, if time permits, we will take it up, but understand the background where it is to be used. Thank you.